Imagine a patient who has been kept alive on a constant, aggressive intravenous drip of pure adrenaline for 15 straight years. Their heart rate is artificially elevated, their energy is boundless, and they feel absolutely invincible. Now, ask yourself, what happens to that patient's body the exact second you rip that IV needle out of their arm? Welcome to the United States economy. For over a decade, the Federal Reserve acted less like a central bank and more like an enabler, pumping the system full of the cheapest, most addictive drug in financial history, 0% interest rates. From the ashes of the 2008 Lehman Brothers collapse, a $619 billion bankruptcy that nearly destroyed global finance, the Fed slashed the federal funds rate to near zero. But they didn't stop there. They unleashed quantitative easing, literally printing trillions of dollars out of thin air to buy bonds. The Fed's balance sheet exploded from $900 billion in 2008 to a staggering $9 trillion by 2022. The market became utterly addicted to cheap money. Stock valuations defied gravity. Zombie companies survived solely on rolling over debt. Everything went straight up. But in medicine and in macroeconomics, there is no such thing as a free lunch. The adrenaline finally triggered a severe allergic reaction. We call it inflation. And curing inflation requires the most bitter medicine of all, a medicine that guarantees pain. Let's diagnose exactly why the Fed cannot cure inflation without killing the economy. By June 2022, the U.S. Consumer Price Index, the CPI, hit 9.1%. It was the highest inflation rate in 40 years. Suddenly, the cost of living was suffocating the average American. The inflation monster, a beast thought to be extinct since the 1980s, was tearing through wages and savings. Enter Dr. Jerome Powell, chairman of the Federal Reserve. Powell realized the patient was burning up with a lethal fever. The only cure? Bitter, toxic medicine. To kill the inflation monster, Powell had to drastically raise the cost of borrowing. He had to hike interest rates. But here is the dirty little secret of central banking, dictated by a macroeconomic rule known as the Phillips Curve. A.W. Phillips discovered in 1958 that you cannot have both low inflation and low unemployment. You have to pick one. If you want to crush inflation, you must systematically destroy demand. How do you destroy demand? You make money so expensive that businesses stop hiring, companies cancel their expansions, and everyday consumers stop buying houses. In brutal analyst terms, you intentionally engineer job losses. You force a recession to starve the inflation monster of its fuel. The Fed doesn't want to admit this on television. They promise a magical scenario called a soft landing, curing the patient without causing them any pain. But history and math tell a very different story. Let's look at the actual mechanism of this financial chemotherapy. The Fed controls the federal funds rate, the baseline interest rate at which banks lend to each other overnight. In March 2022, that rate was basically zero. Over the next 16 months, the Fed executed the most violent rate hike cycle in modern history, slamming rates up by 525 basis points to a peak of 5.5%. When the Fed funds rate spikes, every other interest rate in the economy follows. The 30-year fixed mortgage rate skyrocketed from 3% to over 7%. Suddenly, a family buying a $500,000 house is paying thousands of dollars more in interest alone. They stop buying. Corporate debt becomes crippled. A tech startup that relied on venture capital suddenly finds funding has dried up because the risk-free rate of a U.S. Treasury bond is now yielding 5%. Why risk millions on a software startup when the U.S. government pays you 5% guaranteed? Capital flees risk. This is not an accident. This is the intended mechanism. The Fed is performing a controlled demolition of the labor and housing markets. But when you pump a patient with toxic medicine to kill a virus, you inevitably start damaging healthy organs. And in finance, the weakest organs always fail first. March 2023, the first major organ failure. Silicon Valley Bank, the 16th largest bank in America with $209 billion in assets, collapses in exactly 48 hours. Why? Because SVB had parked billions of customer deposits in long-term U.S. Treasury bonds back when rates were 1%. When Powell hiked rates to 5%, the value of those old 1% bonds plummeted. It's basic bond math. As yields go up, bond prices go down. SVB sat on an invisible financial landmine. $16 billion in unrealized losses hidden on their balance sheet. When their tech startup clients panicked and triggered a massive digital bank run, withdrawing a staggering $42 billion in a single day, SVB had to sell those bonds at a massive realized loss. The bank died instantly. It was an anaphylactic shock to the financial system. The contagion spread globally. Credit Suisse, a 167-year-old banking titan in Europe, folded shortly after. The market flashed its ultimate warning sign. The yield curve, a chart comparing short-term and long-term treasury yields, deeply inverted. Inversion is Wall Street's most accurate recession alarm. It has successfully predicted 7 of the last 9 recessions since 1968. The patient was going into cardiac arrest. The toxic medicine was working too well. The Fed was forced to create emergency backstops, injecting liquidity to save the banks, while simultaneously claiming they were still fighting inflation with high rates. It was the macroeconomic equivalent of applying a defibrillator while still pumping the patient full of sedatives. So, why can't the Fed stop inflation without a recession? Because inflation is fundamentally a psychological disease. It's an expectation. If people believe prices will rise tomorrow, they buy today, which drives prices up today. To break that psychology, the Fed must inflict enough economic pain to make people fear for their jobs more than rising prices. Economists measure this specific economic bloodletting using a metric called the sacrifice ratio. It calculates the exact percentage of annual GDP that must be permanently lost to reduce inflation by just 1%. And history shows us exactly how high that sacrifice can be. Look back at the early 1980s. Fed Chairman Paul Volcker pushed interest rates to an unprecedented 20% to kill double-digit inflation. He succeeded, but it cost the United States 2 brutal back-to-back recessions. The sacrifice was immense. Today, Jerome Powell knows the ghost of Volcker is constantly the bitter truth that no politician wants to say out loud on television is this: a recession isn't an unfortunate side effect of curing inflation. A recession is the cure. The soft landing narrative is just a comforting bedtime story told to keep retail investors from panic selling. The era of free money is officially dead. The 0% IV drip has been permanently removed. The rehab will be long, and it will be painful. But in a world drowning in debt, this bitter medicine is the only thing preventing total collapse. This video is for informational and educational purposes only, not financial advice. All investing carries risk of loss. Do your own research and consult a licensed professional.